As mutual fund investors increasingly focus on sustainable investing, the financial industry is witnessing a broader trend towards incorporating environmental and social objectives into investment strategies. A fundamental premise of sustainable funds is that achieving long term benefits, such as a reduced environmental impact or community improvements, often involves initial costs, with the rewards manifesting over several years. Investors are therefore encouraged to adopt a long term perspective to evaluate these investments. A significant measure to consider when assessing the sustainable nature of an equity mutual fund is its investment horizon, which can be indicated by the portfolio turnover ratio. This ratio, reported in mutual funds' annual filings and prospectuses, is defined by the U.S. Securities and Exchange Commission as the lesser of total dollar purchases or sales divided by the fund's average value over a 12-month period. A high portfolio turnover rate could imply shorter investment horizons and potentially greater challenges in achieving sustainability goals. An analysis conducting using Morningstar's July 2023 database of open-end funds painted a picture of the sustainable investment landscape, starting with over 2,000 funds tagged as sustainable investments, and refining this list to 201 funds that are strictly equity funds with a sustainable mandate by prospectus, revealed an average 12-month turnover of 57% and a median of 32%. This suggests that even funds professing sustainable investment strategies are, on average, completely turning over their stock portfolios in less than 2 years, with many holding stocks only up to 3 years. Findings show that mutual funds that are genuinely committed to sustainability should maintain a low portfolio turnover ratio to align with their long-term investment horizons. Yet, the sustainability messaging by many equity funds is inconsistent and risks misleading investors, a phenomenon known as greenwashing. In conclusion, for investors focused on sustainability, it is vital to scrutinize mutual funds' portfolio turnover ratio as a key indicator of investment horizon. Sustainable investing necessitates patience, with a focus on holding company investments long enough to realize the combined goals of financial return and sustainability impact. Geeta Rao, a senior lecturer in finance at MIT Sloan School of Management, emphasizes the necessity of a long-term perspective for sustainable investments and suggests that a genuine sustainable investment strategy would demonstrate a commitment to holding company investments for 3 years or more. This approach allows a dual agenda to unfold to the advantage of both investors and the invested companies. Note, the content provided in the article is based on an analysis by Geeta Rao and includes insights from research papers and data from the U.S. SEC and Morningstar. Gold and the so-called digital gold, Bitcoin, have both hit notable milestones, indicating that financial markets might favor the perspective of Fed Governor Christopher Waller over Fed Chairman Jerome Powell regarding potential interest rate cuts next year. Bitcoin has surpassed $42,000 for the first time in several months, while gold has achieved an all-time high despite a slight decline. Tom DeMark, a renowned technical strategist, suggests the possibility of a market retreat in the near future. DeMark's method involves tracking the number of days an asset closes lower than the low 2 days prior, with the countdown to 13 signaling a buy. He asserts that markets often reach bottoms and tops not based on news, but when the last seller or buyer has acted respectively. Earlier in October, DeMark forecasted a stock market rally lasting 3 to 4 weeks, and the S&P 500 has indeed risen about 12% from its October lows. Currently, DeMark predicts that both the Nasdaq 100 and the Dow Jones Industrial Average could reach their peaks as soon as this week. For Bitcoin, an important juncture is approaching as it exceeded its long-term projection overnight. But DeMark notes that Bitcoin's significant market tops or bottoms have not historically occurred over the weekend. Gold, contrasting Bitcoin, may have a prolonged rally if it continues to close above its close from 4 days prior for an extended period, potentially extending its gain for an additional 2 weeks or more. In other market news, stock futures are suggesting a weaker start following a close at the highest level since March 30 for the S&P 500. Corporate events include Alaska Air's agreement to acquire Hawaiian Holdings for $1.9 billion, Roche's purchase of Carmot Therapeutics for $2.7 billion, and Spotify announcing a 17% workforce reduction. The most active stock market tickers include Tesla, GameStop, Nvidia, AMC Entertainment, NEO, BitBrother, Coinbase Global, Marathon Digital, Apple, and Amazon.com. Lastly, the Barclays chart of the day indicates that while disinflation in 2023 has been due to the unwinding of supply shocks, the persistent robustness of the U.S. consumer and labor markets might slow the pace of disinflation into 2024. Oil futures experienced a decline on Monday, continuing their downward trend from last week. The drop followed announcements of voluntary production cuts by OPEC Plus members, which left traders doubtful about how effectively these cuts would be enforced. West Texas Intermediate crude for January delivery dipped by 76 cents, a 1% decrease, settling at $73.31 a barrel on the New York Mercantile Exchange. Concurrently, February Brent crude fell by 78 cents, also accounting for a 1% fall, with a barrel costing $78.10 on ICE Futures Europe. In the energy products market, January gasoline saw a decline of 0.7% to $2.07 a gallon. Interestingly, January heating oil saw a slight rise of 0.2%, reaching $2.6666 a gallon. On the other hand, January natural gas slipped by 2.5% to a price of $2.743 per million British thermal units. The crude market continued to react to OPEC Plus' decision to decrease output by roughly 2.2 million barrels a day for the upcoming quarter. This figure also encompassed Saudi Arabia's anticipated extension of its 1 million barrels per day voluntary cut and Russia's reduction of 300,000 barrels per day in exports. Analysts expressed skepticism toward the voluntary reductions due to concerns about compliance. Michael Tran from RBC Capital Markets highlighted the confusion investors are facing and the lack of clear indicators that could guide investment decisions. He predicted that until there is solid evidence regarding compliance with the cuts, prices are expected to be volatile and potentially erratic. Furthermore, traders are paying attention to geopolitical tensions in the Middle East, particularly the recent maritime attacks connected to the Israel-Hamas conflict. Notably, Houthi rebels targeted commercial vessels in the Red Sea, and a U.S. warship repelled drone attacks during an hours-long confrontation. Although oil prices initially surged following an attack by Hamas on October 7th, they have not threatened their late September peaks, largely because concerns about a major conflict affecting crude supply have subsided. The Associated Press has contributed to the coverage of these events. Bond prices were declining on Monday as investors reflected on recent statements by Federal Reserve Chairman Jerome Powell. Powell sought to temper expectations for a reduction in interest rates. The yield on the 2-year Treasury note increased by 6 basis points to 4.608%, indicating a decrease in bond prices as yields and prices move inversely. This followed a notable drop of 39.2 basis points the prior week, which was the largest decrease since March. Similarly, the yield on the 10-year Treasury note rose by 5 basis points to 4.252%, after a significant decline last Friday to its lowest point since September 1st. Over the last week, the 10-year rate had fallen by 25.8 basis points. The yield on the 30-year Treasury rose marginally by 2 basis points to 4.41%, continuing from a fall the previous week where the yield decreased by 20 basis points. Market movements came despite Fed Chairman Powell's recent comments about continuing to increase interest rates if necessary, opposing speculation about a potential rate cut next year. November saw the most substantial monthly declines in 10- and 30-year yields since August 2019, fueled by optimism that a reduction in inflation would lead to the Federal Reserve lowering rates. Investors are closely monitoring economic indicators, such as manufacturing data, that shows ongoing contraction and are anticipating the non-farm payroll data that might influence the Fed's decisions on interest rates. According to Russ Mould, investment director at A.J. Bell, any significant growth in unemployment rates will be closely observed for indications of a potential shift in the Fed's position, as uncertainty about the U.S. economy's future increases.